All right, thanks, guys. Yeah, it's been a wild couple of weeks of economic data that has, quite frankly, told us as of this morning that this inflation is still a problem and this inflation is not going anywhere. We're always happy to have the chief economist and global strategist and founder of Euro Pacific Asset Management, Peter Schiff, on the show to help us shed a little more insight into what has transpired over the past couple of weeks. And we'll go back to last week where we got the last non-farm payrolls number. We'll touch on the two data points this week and even the number this morning that has been, still indicating the fact that not only is this inflation still around, but still indications that we're not only not going down, but we could possibly be going up. Peter Schiff back with us. Great to see you, first of all. We appreciate you taking the time this afternoon.
Oh, my pleasure.
It's, as I mentioned, been just a crazy couple of weeks as far as economic data and indications that this inflation battle is not only still underway, but might be going in the wrong direction. I want to start first off going back to last Friday and this non-farm payrolls number that we got. Give us your take here. I mean, way higher than expected, but specifically we saw full-time work actually down, and most of these new jobs coming on the part-time side of things. Break this down. What does this mean here?
Well, first of all, we shouldn't be surprised that inflation isn't going away because the Federal Reserve spent over a decade deliberately pursuing a policy of creating inflation. Year after year, the Fed kept interest rates at zero and kept the monetary spigots open, doing QE after QE, because they claimed we didn't have enough inflation. And they were going to solve the problem by creating more. Well, they succeeded. They just succeeded to a much greater degree than they bargained for. So they didn't just get us up to 2%, they got us up to 10%. And if you, measured it accurately, closer to 20%, it's come back a little bit since the peak. But we're going to be experiencing the consequences of years of 0% interest rates and quantitative easing for the rest of this decade, if not more. So get used to high inflation, double-digit inflation, for as far as the eye can see. This is the new reality for America. It's very unfortunate for average Americans whose living standards will be eviscerated through this inflation tax because the cost of living is going much, much higher than we've already experienced. But investors have to also understand how the landscape has changed and how they have to completely, redeploy their portfolios, because everything that worked when the Fed was able to create all the inflation is not going to work as that inflation now manifests itself in consumer prices. And so we're going to be seeing higher nominal interest rates, higher inflation, and that means lower multiples for growth stocks, and it means you need to be invested in value, in dividends, internationally, in emerging markets, in commodities. Look at gold up today, up over $60 an ounce. Oil's up about $4 a barrel. Get used to that. That's what is going to be happening, on a much bigger scale. Commodities up, gold up, but you're going to see a lot of pressure on U.S. stocks. U.S. bonds, now this is going to be the third year in a row where bond prices have declined. Bond prices should be down again next year. It'll be 4 years in a row. I mean, that hasn't happened since the 1970s, but this is going to be worse than the 1970s. Those job numbers, despite the fact that the Biden administration and a lot of other people want to make a big deal out of all the jobs that were created, these are jobs that people don't want. These are second jobs. These are third jobs. These jobs exist because people can't survive on one job anymore. People need 2 or 3 jobs to pay the rent, to pay the grocery bills, to keep the lights on. And so that's what's happening. And if you look at the actual numbers for September, we lost about 800,000 full-time jobs. The reason we gained 300,000 jobs is because we replaced those full-time jobs with part-time jobs. So people need more part-time jobs to get the income of a full-time job. And that's what's happening. And these part-time jobs that were created in September, they went to people who already had jobs. It wasn't like people were unemployed and now they got a job. It's people that had 2 jobs now have 3. But why do they have a third job? Because prices are going up. And so this is the reality, that these jobs don't reflect the strength of the economy, but the weakness.
When we zoom out then and have a look at what happened this week, and we'll touch on you know, the CPI print, obviously, going along the lines of what you're saying here, this is something that has been not only in the works, but has been, I guess, basing is a good way to put it, for the past couple of months, in that we haven't seen the follow through coming off of 9% all the way down to a 3 handle now. But you're of the opinion that not only is this the bottom, but you know, we should go right back up.
Yeah, you know, if you look at it like a chart or something, inflation broke out in 2021, right? We went from having inflation, you know, at least officially a little below 2%, 1.5%, 2%, and it spiked up, and it got up. The high was, you know, 9-ish, but we've now pulled back, and the low watermark, the trough of the pullback, was year-over-year inflation of a little north of 3%, and now we're headed back up. Now we're at about 3.6, 3.7, but by next year we could be at 9 again, year-over-year. We could be higher, but I think that the disinflation, in that the year-over-year decline in the rate of inflation, that's over. And even core, if you look at the inflation numbers we got this week, core CPI was still up better than 4% year-over-year. That's still double the 2% so-called target. So we're not even close to that target. Because remember, when we were below it by just, you know, a small amount, when we were at 1.5, 1.6, 1.7, the Fed was like, oh, this is terrible. We need all this stimulus to try to get the 1.7% inflation up to 2. Well, when you're at 4, you're much further away on the high side than we ever were on the low side. But what is the Fed doing? I mean, they're doing quantitative tightening, but it's not nearly as rapid as the QE was. I mean, the balance sheet is barely below $8 trillion. That's enormous. And the Fed is pretty much done hiking rates. They've almost said that they've stopped at 5.25, 5.5. Well, what if inflation keeps going up? What are they going to do? They don't have those bullets left in the chamber. It's empty, right? So if inflation now goes to 5, 6, 7, how are they going to fight that if they're done raising rates? What are they going to do?
And yet the market still seems to be in a spot here where, you know, it's really unclear of what to do with this data. I want to touch on yields here. And you mentioned the bond market there at the beginning. You know, 15, 16, 17-year highs across the board, depending on what day it is, it seems. What do you make of this narrative that we've heard a little bit more of this week, specifically when it comes to the longer term, the 30-year, and that being able to, in itself, control this mess in some way?
Well, you know, the 30-year is going a lot lower in price and higher in yield. I mean, we're not even really at 5% yet. What are we, at 4.8 or something like that? I mean, we still have an inverted yield curve. And it makes no sense to buy a 30-year treasury at 4.8 when you can get 5.5 on a 90-day T-bill. It only makes sense if you believe the Fed is going to be able to bring short-term rates all the way back down again, and that the yield on a 30-year is going to go back down, you know, to a 3 handle or a 2 handle. But that's not going to happen. Inflation is headed higher, and so yields are heading higher, and the yield curve is going to normalize. In fact, it's going to get very steep. So I think the yield on a 30-year treasury, which now is below 5%, probably by the end of next year will be north of 7, maybe 8% on a 30-year. But that won't be the top. I mean, the rates are going much higher.
So when we touch on, leaning on that a little bit, when we touch on the shorter term numbers then, the 2 and the 10-year, the volatility that we've seen just in the past couple of weeks here necessarily pointing to that same narrative then, that not only is this not the bottom, but as you're saying, going higher.
Yeah, and you know, I still believe that we're going to have a recession. I'm still in that camp. In fact, I think it's a depression. I think to call it a recession won't do it justice. It's going to be worse than the Great Recession that we had after the financial crisis of '08. But it's not going to solve the inflation problem. It's actually going to exacerbate it. See, that's what a lot of people don't get. They assume that, hey, if we just have a big recession, that's going to cool inflation. It's not. It's going to heat it up. Because as the economy weakens, the already horrific budget deficits are going to get even bigger. Right now, we're running budget deficits that exceed $2 trillion a year. Well, when we go into a recession, the budget deficits are going to be $4 trillion a year. That's enormous inflation. The Fed is going to have to go back to quantitative easing, even if it still has rates at 5%. In order to finance the deficit, it's going to go back to QE. Now, if the Fed doesn't do that, then the government has to default. It will be impossible for the U.S. government to service its debts unless the Fed cooperates, because it won't be able to find buyers in the private sector for those bonds at a yield that it can afford. I mean, right now, interest on the national debt is getting close to $1 trillion a year. It's already over $700 billion, or maybe $800 billion by now. It's the third biggest line item in the budget, behind Social Security and Medicare. But by the end of 2024, sometime in 2025, interest on the national debt will be over $2 trillion, which means it will be the biggest expense of the government. It'll be bigger than either Social Security and Medicare. And if you wait a couple more years, it'll be bigger than Social Security, Medicare, and national defense combined. That's how high rates are going, because of how much debt we have and how rapidly we've added almost $1 trillion to the national debt in the last 2-3 weeks. I mean, maybe 600 billion. I mean, the trillion before that was added in 3 months, but now they're racking up even faster. So we're going to be at 40 trillion in debt sometime by the end of next year. And then if we go into a recession, the number can hit 50 trillion pretty quickly. I mean, it is just spiraling out of control. But if we have a $50 trillion debt, what if we had to pay 10% interest on the debt? That's $5 trillion a year. I mean, the government only collects $4 trillion a year in taxes. So this is a completely unsustainable situation.
I want to get your take here on what happened.
Even at the current interest rate of 5%, in a few years, interest will consume 100% of tax revenue. That means the government won't have any money to pay Social Security, Medicare, national defense, anything it does, unless it borrows it. It won't have any tax revenue to pay for anything, because all the tax revenue will be earmarked to pay for prior expenses, to service the debt.
I want to get your take, Peter, on what happened yesterday in the market, because I've been sitting here 10, 11 years now watching the market on a full-time basis, and something happened yesterday that was very rare in the sense that I hadn't seen that in my time watching on a daily basis, and that was a 30-year bond auction that caused the reaction that it did to stocks. And it was simply, it seemed anyways, because they had to go so high in the price that the bond auction then went off at to find buyers, that we saw that steep sell-off into the close yesterday.
Well, the amazing thing is that there are still buyers. I mean, at some point, there will be no buyers. The Fed will be the only buyer. I mean, what idiot wants to buy a 30-year U.S. government bond with a yield below 4% or 5%? I wouldn't want to buy it. I mean, what's the odds that inflation is less than 5% a year for the next 30 years? I mean, almost insignificantly low. I mean, inflation is far more likely to average 10% a year over the next 30 years than 5%. So if you're going to loan money to the U.S. government for a 30-year time period, you're going to need at least 10% to break even, if not more. So at the, with the 5% or rates that are available, it makes no sense for there to be any buyers. There should be all sellers. Anybody who owns a U.S. Treasury now should be trying to get rid of it. So I mean, the prices should be a lot lower, and they're going to be a lot lower. We're going to have a crash in the bond market and a crash in the dollar. I mean, this is what's coming. This is the consequence of all the monetary policy mistakes and fiscal policy mistakes we've been making, for more than a decade.
All right, I want to wrap things up here with a take on, you touched on both crude oil and gold to start things off here, but I'm sitting here looking at 5.25% on crude oil today to the upside on what seems to be this Russian headline of new sanctions, regardless of the reason. This is not helping as far as prices are concerned.
Well, no, oil prices are going to go up anyway. But wait till the dollar starts to fall. We've got, you know, $85 oil headed to 100 with a strong dollar. Now, wait till the dollar weakens. Then you're going to see $150, $200 barrel oil. I mean, that could happen next year. I mean, we're very close to the moment where, you know, the dollar tanks, because everything that's happening is negative for the dollar. So keep an eye on dollar, keep an eye on gold. I mean, today's action in gold is encouraging. I mean, if you're in gold, you know, up about $60, but, you know, we're still, you know, well south of 2,000 an ounce in gold. But once gold really starts to break out in a big way, and I expect that at some point you're going to see gold moving up in $100, $500 clips. I mean, it's going to jump pretty big once, you know, the momentum really comes in. And then the dollar can really collapse, because that is a loss of confidence in the dollar as a store of value, as a reserve currency. And when the dollar goes, the Treasury bond market goes with it, because that's all Treasury bonds are. They're future obligations to pay dollars. And if you don't want dollars today, you sure as hell don't want dollars 30 years from now. And so the Fed has to step in, unfortunately, and print even more of a currency that nobody wants. And it just creates a panic. It creates a potential hyperinflationary cycle.
And in a time of maximum uncertainty, or, you know, a lot of people that are watching have never experienced, obviously, these types of conditions. Great insight, as always. Chief economist and global strategist and founder of Euro-Pacific Asset Management, Peter Schiff. Check out his podcast. Very, very insightful podcast as well. Thank you, sir.
Sure thing.